Well, happy is a strong word, but I do agree. I think the technicals are better, and there are a few reasons for that. One of which is, look, it's not clear that we've hit the absolute bottom, but we are seeing some pullback in volatility. It looks like some of the forced selling that characterized the market a few weeks ago, where you saw risk parity funds, levered funds, equity long short, all sorts of different players just dramatically reducing leverage. It looks like we've worked through a lot of that. And your point about credit, we did see a little widening of spreads, but we are definitely in a much better place than we were a couple of weeks ago, when it wasn't just the credit markets, it was the money markets, even the treasury market looked dislocated. I don't think you're seeing that same type of liquidation today. This, to me, is the normal process of backing and filling as you form a bottom.
So, Russ, how do you make a call from here on the stock market without knowing how many cases there are in the U.S., how many deaths there will be in the U.S., how long we're going to be working from home and sheltering in place, how long it's going to take to get tests out onto a broader scale? I mean, these are questions that even the doctors don't really have answers to, because we've never experienced anything like this. So how do you take those sort of big questions, which have been driving the uncertainty on the economy and the markets, and formulate a view on stocks?
Well, I think the short answer to your question is you do it very humbly because of all the reasons you just cited. We don't know the path of the virus. We don't know when the lockdown is going to end. We don't know the path to recovery because we've just never seen anything like this in modern times. So you have to acknowledge the uncertainty. I think what you do is you look for a couple of things. One, rules of thumb. We're likely to see the credit markets bottom before the equity markets. So I think you're totally right, to begin this discussion, what's happening in credit markets, that's a key variable. The second, obviously, is going to be to get whatever indication we can, both out of Europe and the U.S., which are now the epicenter of this crisis, of how the virus is progressing. We're starting to see some deceleration. And then finally, I think the other thing to look for are valuations. Stocks are a lot cheaper than they were. You can debate if they're actually cheap depending upon the metric you use. But the reality is, can you on a bottom-up basis find good companies that even on your worst-case scenario appear to be trading in a bargain? And that's when I think you'll start to see more sustained money coming back into the market.
What about on the flip side, Russ? Are there protection-type assets that are still worth buying even though they've appreciated in value?
Wilfred, I think that's key. I mean, we're basically doing a couple things in the portfolio. One, on the equity side, I think one of the things you can do for protection is you can emphasize qualities of style. What does that mean? Fortress-like balance sheets, companies that can get through this, earnings consistency. Outside of equities, I think the hedges are really the ones you typically look to, and quite honestly, they've worked. Not every day. We've had days when gold has not behaved, when treasuries have not behaved, but if you look at what rose in the first quarter, it was exactly what you'd expect to rise. It was treasuries, it was bonds, it was the dollar, it was yen, it was gold. I still think in an environment where your big risk is this huge economic uncertainty, those hedges still have a place in the portfolio. They're likely to continue to work.
You said to find good companies that will survive with good balance sheets. I know you can't necessarily name names, but give us a sense of what types of companies, what types of sectors investors should be looking to for that right now.
Absolutely. So, the truth is they're mostly the places we were emphasizing before, because I think a lot of these are going to see not obviously a benefit from this, but perhaps some of the changes we're going to see both on an economic basis, a societal basis, are still going to favor sectors like technology, software, healthcare, particularly services, and pharma. We still think there are some models on the consumer side when you're talking about media, entertainment, that are going to continue to work. Obviously, everything is going to be correlated when we don't know how fast the economy is going down. But a lot of the sectors and industries that I discussed, these are places we see high quality, we see very high profitability, and we're confident they're going to make it through this environment. What I'd be cautious on doing is what typically works at the bottom of a bear market. Normally, you load up on value, you load up on cyclicals, and that's because often you get that V-shaped recovery with pent-up demand. As you pointed out, we don't know how this recovery is going to play out. I'd be much more cautious about that type of a strategy.
Yeah, our friend Kenny Placaria, trader, weighing in on that on Twitter, saying this is about active versus passive management when it comes to choosing the companies and not just choosing the index. Do you see this, Russ, as a defining point, a turning point in the sort of decades-long debate?
Well, look, we still think there are a number of reasons why we've seen the move towards exchange-traded funds and other index products, and that's likely to continue. But I do think this is a stock picker's market, because even when you cite the industry, the segment of the market you'd like to be in, the reality is there are going to be winners and losers. And you think about the consumer space. There are business models that are going to benefit from this, and there are also businesses that are probably going to be put out permanently. Mm-hmm. And you do have to distinguish between those.